You're scrolling through your feed, and suddenly, headlines scream about job losses, skyrocketing debt, and economic doom. Sound familiar? It's not just clickbait. It's real. What if I told you the 2026 recession isn't some distant threat? It's already unfolding right under our noses? And today, we're diving deep into a documentary-style breakdown that'll open your eyes wide. We'll uncover 7 undeniable signs, backed by rock-solid data, that prove we are already in the early grips of this downturn. And stick around to the end, because I'll share 3 simple steps to protect your wallet before things really heat up in March. If you're ready to get ahead of the curve, hit that like button now, and let's jump in. First up, sign number 1. Household debt is exploding like never before. Picture this: families across America maxing out credit cards just to put food on the table. As of October 2025, U.S. credit card balances have shattered records at $1.233 trillion. That's a whopping 60% jump from pre-pandemic days, straight from the Federal Reserve Bank of New York. And get this, Wallet Hub's latest prelims show it climbing even higher to $1.33 trillion by year's end, with the average family owing over $11,000. Delinquencies? They're up 63% in hard-hit areas since 2021, according to the St. Louis Fed. You might be wondering, why now? Blame sticky inflation forcing folks to borrow for basics. When debt piles up like this, spending grinds to a halt, and boom, recession mode kicks in. If your own balance is creeping up, you're not alone. But let's keep going. Now, sign 2. The yield curve, Wall Street's ultimate fortune teller, is inverting again, and it's screaming trouble. Last week alone, the spread between 10-year and 2-year treasuries dipped negative, meaning investors are betting on short-term chaos over long-term wins. This bad boy has predicted every single U.S. recession since 1955, with an 87.5% hit rate per charts. Right now, it's hovering at plus 0.58%, but experts at Capital Economics warn that new fiscal moves could flip it back under zero by early 2026. Think about it. When yields invert deep, like that brutal 16-month stretch in 2023, economic pain follows within a year or so. Bonds don't play games. This is a clear signal that borrowing costs are about to spike and choke off growth. Scary stuff, right? Shifting gears to sign 3, big tech giants are hitting the pause button hard, and it's sending shockwaves. Take Amazon. They've frozen retail hiring budgets flat for 2025, impacting thousands of roles as they slash costs, per internal leaks reported by Business Insider. And Tesla? A total hiring freeze through December, with job offers yanked and transfers halted, confirmed by insiders on Blind and Reddit. This isn't random. Amazon's retail boss is talking about belt tightening into next year, echoing Tesla's 2022 cuts before demand tanked. When these powerhouses, who employ millions directly and indirectly, slam on the brakes, suppliers suffer, jobs vanish, and consumer confidence plummets. Ask yourself, if tech's freezing up, could your industry be next? The ripple effect is real. Sign 4. Global trade is grinding to a screeching halt, and it's dragging us all down. Imagine massive cargo ships sitting idle. Container rates from Shanghai to LA have plunged 58% year over year to just $2,196 per box, according to Drury and Reuters. The UN's trade watchdog reports maritime growth stalling at a measly 0.5% for 2025, hammered by tariffs, Red Sea disruptions, and too much supply. With Trump's 25% tariffs already biting, U.S. imports surged early then nosedived, per Freightus data. Empty ships mean idle factories, lost exports, and a full-blown demand collapse. This isn't just about logistics. It's the global economy flashing warning lights. How exposed is your own job to this? Okay, sign 5. Even Walmart, the king of recession-proof shopping, is sounding the alarm, and that's huge. Their CFO, John David Rainey, dropped a bombshell last month. Lower-income shoppers are pulling back big time amid affordability squeezes. Walmart even cut its 2026 sales forecast to just 3 to 4% growth, way below expectations, blaming uncertain times and tariff threats. They're spotting stress behaviors like more deferred payments and fewer splurges. If Walmart's everyday customers, 1 in 7 Americans, are pinching pennies, The entire retail world feels it. This is like the canary in the coal mine dying. We can't ignore it. Sign 6. The job market's shiny surface is cracking wide open. U.S. job openings? Stuck at 7.67 million in October, the lowest since mid-2021, while new hires dropped a massive 218,000 to 5.15 million, per the BLS JOLTS report. Layoffs hit nearly 1.9 million, the highest since early 2023, and quits, a sign of worker confidence, are at a 5-year low. Forecasters are eyeing November payrolls adding under 38,000 jobs, with unemployment ticking up to 4.5%. When hiring stalls and pink slips fly, people stop spending, and the whole system spirals. One layoff notice could change everything, yours included. Time to build that buffer. And sign 7. The human side is heartbreaking. Desperation is spiking nationwide. Google searches for food banks near me have rocketed to 2008 Great Recession levels in 2025, fueled by SNAP delays and unrelenting inflation, as reported by CNN and Google Trends. Places like the LA Regional Food Bank are serving over 2,000 families a month, with supplies stretched thin. Low-wage growth isn't keeping up, pushing 1 in 10 Americans into tough spots, per Walmart's own insights. When basics like food become a struggle, it's not just stats, it's our neighbors, friends, and maybe even you feeling the pinch. This is the real cost of an economy on the edge. Pulling it all together, these 7 signs, debt overload, yield flips, hiring freezes, trade crashes, retail warnings, job vanishes, and rising desperation, aren't random dots. They're connecting into a storm. Economists on X are pegging a 32% chance of full recession by mid-2026. But if tariffs amp up, it could hit sooner. Treasury Secretary Besson insists no recession thanks to tax cuts. But even he admits housing's already in one. The potential trigger? March 2026 earnings reports exposing the damage. But here's the silver lining. History shows post-recession bull markets deliver average 68% gains in the S&P, per market watchers like Ryan Detrick. Prepare smart, and you could come out stronger. So, what can you do right now? Here are 3 actionable steps to recession-proof your life before March. First, build a cash fortress. Aim for 6 to 12 months of expenses in a high-yield savings account, where rates are still around 4% or better. Second, hedge with gold. It's up 20% this year and acts like a shield in tough times. Third, launch a side hustle. The gig economy's exploding. Hop on Upwork or similar for an extra $1,000 a month without quitting your day job. If this hit home, grab my free 2026 Recession Survival Checklist in the description. It's packed with templates, tools, and alerts to keep you one step ahead. Drop a like if you're feeling more prepared. Subscribe for more eye-opening finance talks every week. And comment below. What's your biggest economic worry right now? Let's chat in the comments. Thanks for watching. We've got this together. See you in the next one.